Why would you possibly pick Whirlpool as a stock to talk about? Well, if you're getting towards retirement age or getting a little bit older, and dig into the financials a little as to the price to earnings ratio, the dividend that they're paying, and some other things going on in Whirlpool, I feel like I missed an opportunity when the price was actually lower, but still see it as a really attractive opportunity as I'm getting into the later years of my life. Well, hopefully not super later. Hopefully we still have some time to go. Anyway, this video is going to be super interesting. I'm going to dig into Whirlpool. I'm going to talk to you about why I love Meta so much, and I'm even going to compare Target to Walmart to show you why I like Target so much. So stick around, it should be pretty cool.
Want to make your money work harder? Enjoy another video with Adam Kahn, the rational investor on stocks, real estate, and crypto. Subscribe now for your weekly dose of investment insights and hopefully learn a thing or two.
So, why Whirlpool? Like, what's interesting about Whirlpool? Why would I look into it, and why do I even care? Because here's the negative with Whirlpool. Talk about super boring and nothing into it. Like, I get that. I don't see any huge growth in the future. I don't see it like booming and being incredible. But what I do see as super attractive is they pay over a 6% dividend with a payout ratio of, forgive me, I have to look. My brain is not the greatest. 68.57. So it's not even like they're in jeopardy of having to cut that dividend or anything else. And this is after watching their earnings drop dramatically. So during COVID, when the boom was going on and everything else, they were making like $25 per share that's dropped to about 12. Now, what I really think is this is more normal, the $12. But the $12 is really reasonable, and if it can grow at a slow pace from here, because I don't see Whirlpool having any major problems. Like, hopefully, they can continue to grow now that things have kind of slowed and normalized a bit. And they're paying a 6% dividend with plenty of room to be able to afford that. So, as long as they keep selling us those appliances and continuing to do what they do, they'll be just fine. Now, keep in mind, as always, this is not financial advice. You need to do your own research. Don't listen to me because I'm just some guy on YouTube and I'm just sharing the information that I find. And it's nothing that you guys should use for your financial decisions. Like, really, go find a financial advisor, do your own research, whatever it is you need to do that fits your portfolio. For me, getting into my 50s and starting to think about when I get into my 60s and 70s and retirement, getting a 6% yield on an investment is super attractive. I start to get concerned because once it gets that high, I start to worry that companies are taking on risk to be able to make that payment. However, when I dig into Whirlpool's financials, it really doesn't appear to be the case in their situation. It looks more like things have slowed down, the stock prices come down, and as the stock prices come down, that yield has improved. I think when it dropped below $100 a share, which wasn't all that long ago, that was a really good opportunity. And in some ways, I'm hoping it gets back down there with nothing else changing. I'd be a little cautious if the stock started to fall back down there as to what's going on and why. But if really it's just the cycle of supply and demand in terms of the stock, not in terms of their products, well, that'd be a great opportunity to pick up some more shares at a lower price. My biggest concern with Whirlpool is their margins. Their gross margins are a little over 15%, and their net margins are around 3%, which is not so high and doesn't give them a lot of wiggle room. But I'm hoping part of that is when they do sales and what other things they do to discount the prices so that they don't make a ton of money on the products they're selling. Now, again, at the same time, if inflation continues and they're able to raise prices, the margins should actually improve as well. So maybe there's a potential for that to become better over time, but I'm not counting on that. What I'm hoping for me, in terms of my investment in Whirlpool, is getting that dividend check and being able to use it as I get older and want to not work as much as well, I don't work that much as it is. Anyway, that's my thought on Whirlpool. Now, the next thing I want to do is I'm going to dig into Meta's financials a bit because, as you guys know who've been watching me for a while, I really love Meta. I love the company. I think people like to hate Mark Zuckerberg, although he's not in the news so much anymore like he used to be. And I think that helps to keep the stock discounted. And even though the share price looks high, I don't think the stock is all that expensive. And they're a huge grower and they have unbelievable margins, which is what I love so much about the company. And as somebody who used to have a restaurant, what I can tell you is when I would advertise on Instagram and Facebook, it was really the only advertisement that I could do that I saw immediate returns and knew where it was coming from. If I did those mailers or some of those other things, even if they had coupons, if I did Groupon, it was like the worst because so much of it goes to Groupon and you're discounting it on top of it. So you're just hoping to drive people in the store who maybe hadn't found you before, but they're also the coupon cutters. So it's people who you generally don't even make money on, but hopefully it grows your business. As opposed to Instagram and Facebook, where I didn't really even have to do a discount. I just had to do something that would show our products and do a great video of, a special pizza I was doing, or we did some really, we made this one that was like half pizza, half calzone. Um, and then we did a bunch of calzones with different fillings and stuff, and it made for great content. And what was super amazing is those would go out on a Tuesday, and by that night and even into the next day, people were coming in and ordering what we had done on the video. So you could see the instant return, and you could even target it to locations and demographics, people who like food. Like, it was really an amazing platform for advertisements for a local business of just a small little restaurant. Like, we were just mom and pop, it was just my shop, and pretty amazing. So that's part of what's always been my attraction towards Meta and Facebook. Now, as I've started watching it as an investor, I love the Oculus and the route that I see him going because I really hope that that's the future. And I think Apple sees that with their Vision Pro as well. I just worry about Apple's valuation, but that's another story. We're not talking about that today. So I'm going to take out my handy dandy little cheat sheet here and tell you why I really love Meta in terms of the financials. So Meta's gross margins, 81.5%. I mean, that's just obscene. That's so amazing and so incredible. Like, how many companies out there? I know Nvidia's making all sorts of great margins, but nobody talks about Meta and their ability on this. And I don't see a whole lot of like, they have competitors, but there's no, like, they are it, and I don't see that changing for a long time. And their net profit margin is 36.38%. Again, another incredible number. So that's part of why I love Meta. And then when you dig into their PE ratio, the valuation really isn't that bad. They're trading right around 27 times earnings, which is really reasonable for a company growing at the pace that Meta has grown. Now, it's not the bargain of the century that it was when it fell, but it's still fairly valued in my personal opinion. Their price to sales is 9.64. Their price to cash flow is a little high at 18.68, but again, they're in a high growth area. So it's to be expected that that might be a little high, and it's in line with others who are competitors. So I don't really see it being as outrageous. Their other thing is their return on investment is over 27%, which is really good return when they're investing in things. And then the other thing I love, as stupid as it is their dividend. Their dividend is a tiny fraction of anything, but its payout ratio is only 6.75%. So even though it's a nothing, it's got immense room to grow, which is kind of cool. And I think there's real opportunity as they mature over time that that dividend will actually become significant over the next 10 or 20 years, which is what I hope for. And then the last thing I want to get into, and it's not really last, and it'll take a minute, so forgive me that I ramble for so long. And I hope you guys had a good week. I hope, despite the Fed and the market collapsing that one day, I hope the comeback yesterday was good for everybody. And I hope that everybody's had another good week in the markets. But I want to talk about Target in comparison to Walmart. And this is why I really love Target so much, even though the street seems to love Walmart so much. I'm going to dive into Target's numbers first, and then we'll go look at Walmart's numbers. So Target's PE ratio is 13.93, really low for what they're growing at and what they are. Their price to cash flow is 9.34, which is under 10, which to me is awesome. That tells me it's a great value right now. Gross margins 28.39, which is excellent. Their net margins is 4.06, which, it's low, but they're in a discount retail space, and that's pretty typical for retail businesses. Again, they're getting a return on investment of about 12%. Their dividend is 3.43%, which is pretty good. I'm happy to get over 3% return on my investment, but it's got a payout ratio of only 47.55%. That gives them a lot of room to be able to grow that dividend right now that's already paying over 3%. So all of that stuff is really good about Target. I think they had a lot of bad press last year, and I think that that's weighed on the stock. Their earnings most recently weren't what the street was hoping for, which puts the price back down. But for me personally, I think that gives opportunity to add on to a position that I already have. And I think Target's going to do just fine. I almost like that they're out of favor. Now let's look at Walmart on the other hand, that everybody seems to love except for me. Walmart's trading at a 37.92 PE ratio compared to Target's 13.93. 13.93 is so much more attractive to me than paying almost 38% for just a retail business that, they're consistent and they do well, but they're not growing at any exorbitant pace. It's actually my concern with Costco, and maybe I should have brought them into the mix as well. But I think Costco's a better run company, just my personal opinion. I don't love Walmart all that much. Their price to cash flow is 23.17. So again, more than double what Target's is. And for a retail company, I think that's getting pretty pricey. Their dividend yield is only 0.3%. Now, again, their payout ratio, not again, but their payout ratio is only 33%. And while that's extremely low, think about what their payout actually is. It's only 0.3%. So even if they doubled their dividend, because they have tons of room to be able to double it, now you're talking about a 66% payout ratio. If they wanted to triple it, they really can't afford to quite go that far. They're giving out all of their income that's coming in, and you still haven't gotten to a 1% return on your investment. So, from my perspective, Walmart is pretty pricey. Target is pretty cheap, but the street seems to like Walmart and hate Target. That's why I actually like Target and don't love Walmart. So those are my reasons on those stocks. I'm curious what you guys think. Do you guys hate Target too? Do you like Meta the way that I do? And what are your thoughts on Whirlpool? Does it make sense? Does it fit your portfolio, or is it just silly because, if you're 30 years old, I don't see any value, just my opinion again, in investing in a company like Whirlpool because you're not going to see the growth over time. I love a lot of the YouTubers, but it's interesting to me to see some of them that are so young and they're so conservative with their investing. And I think at their age, they should probably have some growth and not be so focused on dividend stocks at, 28, 35 years old. You start getting more interested in the dividends when you hit into your 50s and 60s so that you can rely on those dividends and not worry about the ups and downs of the markets, hopefully. I mean, the reality is, no matter what, the company has to make enough money to be able to pay those dividends. And if there's a real slowdown or a real recession, any company is vulnerable to sales dropping off and not being able to make the payments that they've intended to make in the future. So none of it's guaranteed, no future this or future that. Like, we don't know. But for the most part, if you buy boring, comfortable companies, even in downturns, they're usually doing well enough that they can make those payments and they've been through the ups and downs of the cycles before. Anyway, as always, if you haven't already, do me a favor and hit that subscribe button, smash the like button, make some comments in the comment section. I really appreciate that. That helps YouTube's algorithm, that helps the channel grow. I'm super excited to see how many people have subscribed. I'd love to see more interaction. Yeah, I'm probably not going to be able to do a live tomorrow, but I might try. We have my in-laws coming into town. We have the holidays coming up, and things are just getting a little busy with family and life, which I hope it is for you guys too. It's fun this time of year. So again, Have a great week, and I'm sure I'll talk to you sometime this week.